You know that feeling when you're lying in bed, the house is totally quiet, and you're staring up at the ceiling at like 3 in the morning.
Oh, yeah. The absolute worst.
Right. You've worked incredibly hard your whole life. You've saved diligently, played by all the rules. But there's this one terrifying universal fear just sort of lurking in the background of your mind.
Yeah, the financial industry actually refers to it with a very cold clinical term. They call it longevity risk.
Right, which, I mean, that sounds like something out of an economics seminar, but for you, the listener, it's not a seminar. It's the very visceral, stomach-dropping possibility of literally outliving your money.
Exactly.
I mean, you might make it to 95, which should be a wonderful victory, but what actually happens if your bank account completely taps out when you're 88?
It's terrifying. And that reality alters the entire architecture of a retirement. You're suddenly tasked with managing a finite, known pile of resources against an infinite, totally unknown timeline.
And the psychological burden of that unknown timeline is huge.
It really is. It causes retirees to hoard cash, agonize over the price of everyday groceries, and live far below their actual means. They get terrified to spend the money they just spent 40 years accumulating.
But here's the wild part of all this. The financial industry actually built a very specific, mathematically rigid tool designed to neutralize that exact 3 a.m. panic.
Yeah, they did.
And that's why we're here.
Yeah.
We spent the entire week tearing through thousands of pages of actuarial data, underlying tax structures, and this massive, dense, 1,000-question technical breakdown on annuities. Also, you don't have to.
That's right. Our mission for this deep dive is to extract the core mechanics of how you actually protect your future.
And it all starts with a core dilemma that economists call the annuity puzzle. Because if there's a mathematically perfect cure for the fear of outliving your money, why aren't people lining up around the block to buy it?
Well, to understand the hesitation, we have to look at the bedrock product of the entire life insurance industry, the single life annuity.
Okay, let's unpack this. What exactly is that at its core?
At its absolute simplest, it's a contractual exchange of risk. You hand over a lump sum of capital to a massive insurance institution, and in return, they make an unconditional, ironclad promise to pay you a reliable monthly income for the rest of your natural life.
Unconditional is doing a lot of heavy lifting there.
It really is. It means it doesn't matter if the stock market drops by 50% tomorrow afternoon.
Or if global interest rates drop to zero.
Exactly. And crucially, it doesn't matter if you defy all medical odds and live to be 110 years old. That monthly deposit hits your checking account on the exact same day, every single month, no matter what is happening in the global economy.
Wow.
Yeah, you are effectively buying yourself a strict private pension.
And for someone terrified of running out of money, a private pension should be the ultimate silver bullet, right?
But hold on, I have to stop you there.
Yeah.
Because I am channeling the exact hesitation I know you, listening right now, are feeling about this silver bullet.
Let me guess. The bus scenario. Yeah, exactly. What if I take $300,000 of my hard-earned life savings, hand it over to an insurance company, collect exactly 2 monthly checks, and then, I don't know, step off a curb tomorrow and get hit by a bus? Do the executives at the insurance company just throw a party and keep all my money? Because that feels like an absolute scam.
I hear that all the time. You've just articulated the loss of capital illusion.
Loss of capital illusion.
Right. It is the single largest psychological barrier preventing people from securing guaranteed income. And it's entirely rooted in two behavioral economics concepts: loss aversion and the endowment effect.
Okay, let's break those down for a second because we don't want to get bogged down in textbook terms here.
Think about it like this. You spent 40 years aggressively building that nest egg. You checked the balance every month, watched it grow, managed it. You feel immense psychological ownership over that specific pile of money.
Oh, for sure. It's your life's work.
Yeah, and the endowment effect is a cognitive bias, where human beings place a massive premium on things they already possess. Trading a tangible, liquid asset like a number you can log in and look at on a screen for a conceptual, invisible promise of future income feels like completely losing control.
Right, right.
Your brain registers it as a massive, immediate loss.
Well, it feels like a massive loss because in the hit by a bus scenario, it literally is a loss. Your heirs get nothing.
True, but that scenario assumes you're buying the most basic, rigid version of the product, which almost nobody actually does.
Yeah.
The industry built structural safety nets to mitigate that exact fear. You don't have to roll the dice on your own solitary, fragile life expectancy.
Wait, really? So, what do people usually do instead?
Well, if you're married, you simply purchase a joint and survivor annuity.
Oh, meaning if I step off that curb and get hit by the bus, my spouse is completely protected.
Exactly. The insurance company doesn't keep a dime of that capital yet. The income just seamlessly continues hitting the joint checking account for the rest of your spouse's life.
Gotcha. What if you're single, though? Like, if you want to protect your estate and ensure your kids get something out of that $300,000?
In that case, you can attach what's called a guarantee period. Let's say you buy a 10-year guarantee rider. If you live to be 95, the guarantee is completely irrelevant. The company just keeps paying you until you're 95.
Right, because you outlived the 10 years anyway.
Yep. But if you suffer a tragedy and pass away in year 4, the insurance company doesn't just absorb the balance of your money. Your named beneficiaries, like your children or a charity, will continue to receive those exact monthly payouts for the remaining 6 years of that guarantee.
Okay, that makes it vastly more palatable. We've handled the fear of dying tragically early, but I want to explore the mechanics of the opposite extreme.
Okay, let's hear it.
If the insurance company guarantees to pay me until I'm 105 years old, long after my original $300,000 lump sum has mathematically run out, where is the money coming from? They aren't just printing new money.
No, they definitely aren't.
Wait, are they using the leftover money from the people who unfortunately did get hit by the bus to fund the payouts for the people who lived to be 105?
What's fascinating here is that you just reverse engineered the hidden engine powering the entire annuity industry.
Really?
Yeah, it relies on a mathematical concept called mortality credits. Let's visualize this to make the math concrete.
Okay.
Imagine a massive metaphorical stadium filled with 10,000 75-year-olds. They all agree to walk onto the field and put $100,000 into a giant pool in the center.
Okay, I'm picturing a huge pile of cash on a football field.
Right. Now, actuarially speaking, the insurance company doesn't know who is going to pass away, but they know with stunning scientific precision exactly how many people in that stadium will pass away at 78, how many at 85, and how many will make it to 100.
Ah, I see. So as time goes on, the people who happen to pass away early leave the stadium, but the capital they put into the center of the field stays there.
Exactly. It actively subsidizes the lifelong payouts of the survivors who are still sitting in the stands. That pooled risk mechanism provides a unique type of yield that you literally cannot replicate in a standard stock or bond portfolio.
Because if you manage your own money, you have to plan as if you are going to live to 100, which forces you to spend very conservatively.
Spot on. The insurance company pools the risk, meaning the survivors get to safely consume the capital of those who passed away.
It's essentially reverse life insurance, isn't it?
Yeah, that's a great way to put it.
Because with traditional life insurance, you're paying a tiny premium every single month to protect your family against the financial tragedy of you dying far too early. But with an annuity, you're paying a massive premium up front to protect yourself against the financial tragedy of living far too long.
Exactly. And your age dramatically alters the velocity of those mortality credits. Actuaries widely consider age 75 to be the sweet spot to actually pull the trigger and buy an annuity.
Why is 75? Why not like 60?
Because if you buy one at age 60, almost everyone in that stadium is going to live another 2 solid decades. Nobody's leaving early, which means there are very few leftover credits to go around. Your payout is mostly just based on standard interest rates.
But at 75...
Right, around age 75, the mortality curve begins to steepen sharply. More people begin leaving the stadium, meaning the credits distributed to the remaining survivors get significantly larger. That drives your monthly payout much higher.
Got it. Age is a huge factor, but the initial payout is also heavily anchored to the broader economy on the exact day you sign the contract, isn't it? Specifically, the 10-year government bond yield.
Yes, exactly. When bond yields are sitting at, say, 5%, the insurer is able to take your $300,000 lump sum and immediately lock in a massive safe return on their end.
And because they're earning more on your money, they lock you in at a substantially higher monthly payment for the rest of your life.
The math is incredibly clean, it's heavily regulated, and the income is totally guaranteed. But returning to our initial puzzle, the reason people still hesitate is that the decision is entirely irreversible.
Right. Once you hand over the capital, you cannot call them 3 years later and say you changed your mind and want your lump sum back to buy a beach house.
Exactly. And the absolute irreversibility of handing over your life savings is terrifying for an average investor. Because of that fear, the financial industry realized they needed to engineer an escape hatch.
They needed a product that felt like an annuity, but, allowed you to keep your hands on the steering wheel, essentially.
Which brings us to a highly popular but vastly more complex hybrid product known as the Guaranteed Minimum Withdrawal Plan, or GMWP.
Okay, GMWP.
Now, despite how it's frequently pitched in marketing brochures, a GMWP is not technically a classic life annuity. It is a segregated fund. To put it simply, think of it as a standard mutual fund operated by an insurance company, but with a highly specialized insurance rider bolted onto the side of it.
The analogy I kept coming back to while reading through the source documents is bubble wrap.
A bubble wrap.
Yeah, it's like you're keeping your retirement money fully invested in the unpredictable stock market, but you are wrapping your entire portfolio in layers of financial bubble wrap.
Oh, that's actually deeply accurate, because to understand a GMWP, you have to realize it runs on a dual-track system. Two separate ledgers exist simultaneously.
Two ledgers. Okay, walk me through track one.
Track one is your real-world market value. This is the actual cash value of your underlying mutual fund investments. It fluctuates every single day. If the stock market crashes, track one crashes.
Just like a normal RSP or 401k, it's fully exposed to reality.
Right. But track two is your guaranteed withdrawal balance, or GWB. This is a phantom ledger. It is not real money.
Phantom ledger, like fake money.
Well, you can't call them up and withdraw track two all at once. It is simply the invisible baseline the insurance company uses to calculate your guaranteed income. They write a contract promising to pay you, say, 4% or 5% of that phantom track annually for the rest of your life.
Okay, let's run a scenario so we can see this dual track actually function. Let's say I invest $100,000 into a GMWP. Day one, track one and track two are both sitting at $100,000. My guaranteed payout is 5% of the phantom track, so I'm getting $5,000 a year for life.
Correct.
What happens if the global economy melts down the next week and my real market value drops to $50,000?
Your real market value is cut in half, but your phantom track, the GWB, remains frozen at $100,000. The insurance company continues to calculate your payout based on the phantom track.
Wow. So I still receive my $5,000 a year unabated for the rest of my life, even if my real market value eventually hits absolute zero.
Exactly. The insurance company is legally on the hook to cover the difference out of their own pocket.
And that is the floor. That's the downside protection. But the reason nervous investors absolutely flock to these products is the upside potential, right? The magic of resets.
So absolutely, the resets are huge.
So what happens if, instead of a crash, we hit a massive 10-year bull market? My real market value surges from $100,000 to $150,000.
When your real market value hits a new high, you have the option to reset your phantom track to match it. So your phantom GWB jumps to $150,000.
And now my 5% guaranteed lifetime payout is calculated on that new higher number. I basically just gave myself a permanent pay raise.
You did. You permanently ratcheted up your absolute floor.
So even if the market crashes by 80% the day after I lock in that reset, my phantom track stays at $150,000 and my new higher income is locked in forever. I mean, it sounds completely utopian.
It does sound utopian. Upside market growth, an ironclad income floor, and because you still technically own the underlying mutual fund, you maintain the right to cash out your remaining real market value in an emergency.
And here's where it gets really interesting. Bay Street doesn't hand out free miracles. What is the actual structural cost of all this bubble wrap?
The cost is a crushing, continuous financial burden. Because it's a dual product, you're paying two separate layers of fees every single year. First, you pay the standard mutual fund management expense ratio, the MER, to the portfolio managers picking the stocks.
Right, standard mutual fund fees.
Second, you pay an explicit insurance fee to the institution for providing that lifetime guarantee rider. When you combine those, you're looking at a massive structural fee drag of roughly 3% to 4% annually.
4% a year. I mean, we need to pause and appreciate how massive a 400 basis point hurdle really is. If the broader stock market returns 6% in an average year and the insurance company is skimming 4% right off the top before you even see a dime, you are mathematically capping your own growth at 2%.
Yeah, and that 4% drag makes those magical resets we just talked about incredibly difficult to actually achieve in the real world. Your portfolio has to grow past a 4% hole every single year just to tread water.
Okay, let's put these two tools in a head-to-head showdown because this is the exact crossroads so many people face. Let's take a 70-year-old listener with $200,000 sitting in cash trying to decide between the classic life annuity and the flexible GMWP.
All right, if you take that $200,000 and purchase a classic life annuity, you secure the absolute highest guaranteed monthly payout the industry can offer, precisely because you're giving up access to the lump sum. Let's establish a baseline and say it yields roughly $1,200 every single month.
The income is incredibly strong, but the capital is permanently gone.
Exactly. Now, if you put that same $200,000 into a GMWP, the yield drops noticeably. because you're paying for all those internal insurance mechanisms. You might only get $900 a month, but you retain emergency access to whatever cash is left in track one.
That $300 a month gap is profound over a 20-year retirement. I mean, it is exactly like buying a fully refundable business class plane ticket instead of a non-refundable one.
That's a perfect way to look at it.
You're willingly paying a massive liquidity premium purely for the psychological right to change your mind, or to have access to a lump sum to fix a collapsed roof 5 years from now.
The mathematics of paying that $300 liquidity premium are undeniable. But this raises an important question, right? The behavioral economics, how this actually affects a retiree's brain on a daily basis, are completely inverted.
Walk us through the psychology of that. How does the emotional journey differ?
With the rigid life annuity, you experience massive, acute emotional pain up front. Writing a check for $200,000 and watching your net worth permanently drop on your spreadsheet is agonizing.
Oh, I can't even imagine.
But once that singular transaction is complete, you experience total lifelong peace. Every single monthly deposit feels like a guaranteed salary hitting your account. You never have to check a stock chart again. You're entirely insulated from financial media panic.
But with the GMWP, the pain is deferred. You avoid the massive initial trauma because you still technically own the money. You can log into your account and see your $200,000 sitting there.
Right, but because of those 4% internal fees, combined with the $900 you were withdrawing every month to live on, the real value of that account begins to shrink.
Oh, man. So you suffer chronic, ongoing anxiety. Watching your actual account balance slowly, inevitably bleed out over the years is like death by 1,000 cuts.
Exactly. You bought the GMWP to pay a premium for peace of mind, but the daily reality of watching the fees erode your capital turns the product into a daily source of stress.
And there is another layer of stress entirely. What if the stress shifts from the stock market to the institution itself? I mean, what if you give your life savings to an giant and they suddenly collapse like we saw with major banks in 2008?
Counterparty risk is always a factor when you're relying on a decades-long promise. But the Canadian financial system has a remarkably robust safety net called Annuities.
Annuities? How does that protect you?
It's an industry-backed, non-profit organization that specifically shields policyholders from an institution's insolvency. They typically protect up to 100% of your guaranteed monthly income or guarantee the retention of up to $200,000 of the underlying policy value.
Okay, so it adds a critical layer of structural armor to ensure the foundation of your retirement remains intact even in a catastrophic financial crisis.
Exactly.
So we have dual tracks, we have phantom ledgers, mortality credits, 400 basis point fee drags, and Annuities limits. How does a normal person actually execute this strategy without making a catastrophic miscalculation?
They really can't do it alone, because if you check the wrong box on these contracts, it impacts the next 30 years of your life.
You can't just log on to a discount brokerage and click buy on a life annuity. You need a holistic strategy because you're not just making a single product choice, you're architecting an entire retirement structure.
Often, funding an annuity involves liquidating other assets or downsizing a primary residence, which complicates things further.
Which is exactly why attempting to DIY this is so dangerous. You need an expert guide who can see the entire board. And when we were digging into the complexities of executing this properly, the need for a multidisciplinary team became incredibly obvious. We looked at Muniris Financial Services as an exceptional example of how to navigate this exact crossroads.
Having a team that understands the intersection of these different financial domains is absolutely crucial.
Right, because the Muniris advantage is that they aren't just selling one product. Their experienced team includes licensed mortgage brokers and real estate brokers who offer comprehensive guidance throughout the entire transaction.
Which is huge if you need to leverage or sell property to structure this guaranteed income. They handle the whole picture.
On top of that, the firm's CEO, Mansour, is a qualified life insurance broker. This enables clients to access expert advice across multiple financial disciplines, all from a single trusted source, rather than trying to coordinate between, 5 different professionals who aren't talking to each other.
Yeah, that cohesion is so important.
Definitely. If you are staring down this decision and want to cut through the confusion, you can actually connect with the team directly. You can reach them by cell at 778-898-3202. You can email Mansour directly at mansour@muniris.com or just explore their approach at muniris.com.
Getting that kind of holistic structural guidance is vital, especially when we tackle the massive philosophical shift required to successfully manage longevity risk.
What shift is that?
Well, if we connect this to the bigger picture, we absolutely must stop viewing a life annuity as an investment benchmark that we are trying to, quote-unquote, beat.
The analogy of home insurance is the only way this makes sense to me. You happily pay your home insurance premiums every single year, and at the end of the year, when your house doesn't burn down to the ground, you are intensely relieved.
Right. You don't call your broker and complain that the insurance company won your money because there was no fire. Yeah. Becoming completely destitute at age 92 is the financial equivalent of your house burning down. A life annuity is not a Wall Street gamble against your own life expectancy where you are trying to maximize your return on investment. It is strictly longevity insurance.
You're paying a premium to permanently remove a catastrophic risk from your shoulders.
Exactly.
So what does this all mean? Bringing it all together for you, the choice boils down to a fundamental dilemma in your retirement architecture. It's a strict floor strategy versus a flexible floor plus upside strategy.
The classic life annuity gives you absolute maximum income,
While the GMWP gives you maximum flexibility and control. But there is one massive blind spot we haven't talked about yet, a variable we haven't factored into the math. The silent thief of inflation.
Oh, that completely changes the calculus. Because a fixed life annuity is brilliant for guaranteeing your income today. But a gallon of milk is going to cost significantly more in 25 years.
Right, that fixed $1,200 check slowly loses its actual purchasing power as the decades roll on.
Which means the ultimate bulletproof strategy might not be choosing between the two, but actually combining both products into a unified defense.
Oh, a barbell strategy. You use a strict high-yield life annuity to cover your essential fixed baseline expenses, the things you absolutely must pay to survive, like keeping the lights on, paying property taxes, buying groceries.
And then, with your remaining capital, you deploy a GMWP. That captures potential stock market growth to fund your discretionary spending. The vacations, the hobbies, the legacy you want to leave for your kids.
So you lock down the absolute floor with the annuity, but you maintain a controlled, protected exposure to the market's upside to fight off the erosion of inflation.
Exactly. It's about building a custom-tailored structure that manages the cold mathematics, the fee drags, and most importantly, your own psychology, all at the exact same time.
So the next time you experience the 3 a.m. panic, staring up at the ceiling in the dark, wondering if your money is going to last as long as you do, you don't have to guess anymore. You can use this knowledge to finally sleep through the night. We'll catch you on the next deep dive.